This is Satya Pradham of Cirrus Research, and welcome to our quarterly conference call. We've recently released the report, the Cirrus Dispatch, and that's represents really the house views, how we frame the equity markets, and it's really chock full of exhibits that I think you're going to find of use. The title for this Outlook report is Market Crowding Spotlights Changing of the Guard in 24. So what we're looking at is we're coming off of one of the more dramatic years. I think 2023 harkens back to the period back in the 1999 window when only a very, very few stocks really mattered. And this sets up for an interesting and a very potentially challenging 2024. And what I mean by that is that the background is favorable. You've got earnings that are in pretty good shape. They're stabilizing. You've got improving inflation data and so on. So there is a lot of good. And at the same time, because of the fallout of 2023, the sort of fragmented leadership that surfaced, it's really creating a year that's chock full of rotational risks. And really, at the top of this is, in this call, we're going to make a case that equities are favorable. However, you are likely to face rotations within sectors and style from growth to value. And so in some ways at the sector level, from tech to industrials, we'll make that case. It is more of a valuation sensitive market. So maybe we're not in a deep value run, but it's certainly not the mega cap growth of 23. And at the end of the day, a smaller cap focus. A lot of this is painting one word, which is the word is broadening. That the market, we're going to make a case, has already begun to broaden really from the fourth quarter of last year, and will likely become more accentuated as we get into the 2024 year. A few key things we'll tackle here. There are tactical fissures that are opening as crowding risks are surfacing. This is something that will drive the absolute return in markets clearly and potentially really point to a break in leadership. We'll walk through some of the evidence of this earnings cycle. I do know that when you look across the spectrum of market, sort of the consensus view on markets, the idea is that the Fed will ease and ease again and again. Part of that is the profit cycles going to weaken further. There will be a slowdown, and it'll allow the Fed to be easier than we suspect. The data we're looking at really refutes that, and I'll try to make a case for that. It is an easier credit cycle that's allowing us to have this sort of courage. But ultimately, we'll focus on this idea of a leadership handoff and what are the probabilities. We've made this case for a while. It continues to work in the smaller cap arena the last 2 years. It has not worked in this past 6-9 months with the larger cap area. So we'll try to delve into what's working, what's not working. And then finally, a changing of the guards also in terms of quality. In the last couple of years, we've had a real quality bias. At this juncture, it's really hard to make the case, the compelling case we were making 2 years ago, or for this matter, last year. So let's jump into it. The idea of the profit cycle stabilizing, we tend to look at two critical items. One, the idea of where the profit cycle is. We tend to use top line growth because that's tougher, I think, to sort of portray in the wrong way. It tends to be more stable over time, and we can get comparisons that are fairly clean. And in addition to that, we also look at the consensus forecast for growth. After all, you've got analysts that are putting out estimates every day on specific companies. We fold that up into industries, we fold that into sectors, and therefore benchmarks. And so what we can look at is the larger cap names and the smaller cap firms. Across the board, what we are seeing is that the break in top line growth over the last couple of years, really precipitated by the beginning of the Fed tightening cycle, and also, for that matter, the law of large numbers, where you had that sort of post-pandemic moment. You had sort of like a reflation to business from zero to something. All of those things really caused the top line growth to spike and then started to unwind as the Fed really enacted a fairly aggressive rate hiking policy. In addition, though, what we're noticing is that the slowdown in top line growth has finally started to settle out. And one really good hint to this is the idea of where the forecasts are going. And so if you go back about 6-8 months ago, what we saw were forecasts that roughly maybe 55-65% of estimates were getting cut. And today we're closer to a 60%, 50% if you're looking at really at the larger cap area. So broadly speaking, what the forward numbers are suggesting is that the top line growth is most likely stabilizing. And as a result, the forward estimates are starting to reverse course a bit. So this is something that I think is really important to the kind of portfolio design and portfolio discipline. That if you're in a world where the profit cycle continues to fall out of bed, this idea of playing defense, paying up for any company with evidence of growth really works. And that really was a 22 into 23 sort of environment. So in terms of when we step back from the US and look more broadly, this data is very constructive. Most markets that we've looked at are reflecting a similar sort of effect. The idea that top line growth is starting to settle out from the massive reversals seen in the last couple of years. And to some degree, the estimates are picking up. The exception is China still. What we're seeing is that the Chinese top line growth continues to decelerate, really in a pretty dramatic fashion. And more importantly, what's also just as interesting is that we're seeing an important gap in expectations for growth. That the West, if you look at the European data, you look at the US data, Japan, et cetera, we're looking at a stabilization in estimates or even a ramp up of estimates, whereas the Chinese forecast data continues to lag. And so this divide will likely persist. And as that continues, it will continue to place this focus on the key West markets. The other important thing, though, we've also seen a broadening as well in the East, where Asia Pacific estimates are starting to come back a bit. And clearly Japan's estimates are also on the mend. So we think this environment of more of a stabilized profit cycle is not just a unique US situation, but clearly there are some exceptions to the rule. So when we're looking at the sort of growth rate comparisons for company and the estimates are moving in the right direction, what else should we be looking at? And one of the things that we tend to look at very closely here also has to do with the cost of capital. Ultimately, this is the lubricant for growth. We've got companies that will need capital to be able to invest and reinvest. As those credit markets begin to tighten, that's your early sign warning that the growth rates that we're assuming may be at risk. So what we're looking at, and this has been fairly consistent, is exactly the opposite. A scenario in which credit markets continue to rally in, saying we're willing to take on more business risk, not less. We're seeing this in the US, we're seeing it across Europe, we're seeing it in the sterling. Effectively, that just covered about 70-80% of the high yield paper in the world. So what else is going on here? So, when we look at the consensus sort of view on markets, there's some folks that are kind of like the sky is falling kind of outlook. But when we're looking at the data more carefully, it's really hard to come to that conclusion, which really sets up this sort of like challenging environment for 24, the difference between reality and expectations. And I draw the linkage back to 23 when we've had the sort of like the initial regional bank sellout in February, March of 23. The markets really perked up and realized that we had a problem in the making. And the consensus takeaway was that the Fed had gone too far. We're now going into a recession. By the back half of 23, the Fed will probably ease. And what we saw was we did not go into a recession. If anything, we saw a stabilization in growth. Again, we come into this year and we've got, if you look at the at the plots and estimates, we've got a fairly supportive Fed as we go into the first half of the year. What's really interesting, however, is that the credit comparisons, whether we're looking at developed markets or for that matter, even emerging markets, Asia, Latin America, those spreads have all come in. And so what this is saying to us is that broadly credit access is available, and it's hard to see sort of like an adverse hit to earnings growth when the credit backdrop is favorable. Importantly, when we look to really deep cyclical groups such as housing and banking, those spreads are also quite favorable. In fact, they've rallied in more than any of us, I think, had suspected. I think the initial backup in 23 was this massive fear about a banking crisis. Within a few months, thanks to the Fed's sort of support that came into place very quickly, settled the system. And then we also realized that the inflation expectations were probably too high. They came in. We also realized that profitability was starting to bottom. So all of these things really account for where we are. Importantly, though, if you look to this as a forecast for profits growth, you'd have to say the profit cycle is more likely to reaccelerate here. And so with that and record low record low unemployment rates, is the Fed likely to be very aggressive on their rate cuts this year? And I think this is the big question for the first half of the year, that we will likely see more volatility, not less, as we sort of waffle back and forth with how friendly the Fed will be. Yesterday was a great example on the market sell-off. The print was, hey, one of the Fed governors basically claimed that the market may be overinterpreting how easy the Fed will be. Market sells down, bond market sell off. This sort of back and forth is likely to be the situation in the first 6 months of this year. And so what we want to focus on is, what's coursing underneath that's fundamental, that's durable. And the idea is that you're in a profit cycle stabilization. You really do need to focus on companies that are growing their earnings. And in that kind of environment, you want to focus on the best bang for your buck. What are the valuations looking like? Importantly, when we switch over to some of the more active models that we run to model things such as growth versus value, small versus large, all of these things are pointed in one direction now. They're starting to tell us that this equity environment is likely to be more fundamentally driven, not less. Less of a trending market and more of a fundamentals market. And I know that if you're an active fundamental manager, this is like, a wonderful thing to hear. But let me at least defend what we're seeing. The idea behind our style oscillators, it moves between growth and value. And up until, let's say, the summer of 21, the model that was in a more of a lean value terrain had started reverse course. Part of that was really the sort of post sort of like rebound in the economy due to the reopening, early stages of the reopening, and also the threat that the Fed was about to really reverse course on liquidity, which they certainly enacted. As we went into that sort of mold, the models then started to tilt up towards a growth terrain. It stayed there as a growth overweight in the last couple of years, practically. In the last 4-6 months, this model has really tumbled back more to a lean value holding. So underneath all of this is this idea that profitability is more likely to be bottoming and not slowing further. As a result, the Cirrus style oscillator is a lean value. And that is something that's very different from the past couple of years. One disclaimer here, what we're not seeing and stating is that we're going into some effectively a deep value run. It doesn't make a lot of sense to become very deep cyclical in this environment, partly because the economy never melted down into a recession. So the sort of the throes of a true deep value rotation typically occur after some really shock to the economy, really blow up of earnings, and where earnings are finally like we kind of all agree this is as bad as it gets, and that's really the beginning of a deep value run. That is not the kind of environment we're in, but we are certainly in a more fundamentally driven environment. Importantly as well, what we're also observing is that our large versus small indicator, the CTSP, the Cirrus tactical size model, this model has been really fairly aggressively lodged in the large cap overweight segment. That, in terms of holding securities, you want to go higher and higher cap. I think 2023 was the epitome of this sort of signal, and quietly this reading has begun to unfold. It's not telling us to race back to small and micro caps, but it's clearly now a neutral factor, leaning pretty much more small than it's been in 2 years. So this is, again, this change of a broadening. And whether we're looking at more valuation sensitivity or we're looking at a broader lower cap market, you're looking at a very different 24 versus what we experienced in 2023. Let me pull this together now in terms of how the portfolio work should follow. If we're right about this outlook, what we've got to do now is begin to migrate to more valuation sensitive portfolios, especially in the growth terrain. So as a result, we are now lodged in the growth at a reasonable price, a GARP framework in the growth area. We had been in the quality growth segment, and the idea that if the profits are stabilizing, we probably want to be a little less defensive. And similarly, in the valuation, value-driven style, what we are not describing is a deep value kind of world, but it is more of a relative value market, especially if you're looking at a period where the profit cycle may begin to expand. And so this is a big change for us because we've been lodged in the quality bias for quite a while. And I'll come back to delve into this a little bit more. There's a little bit more driving this decision. But let's stay with this current overall equity market. And why do we suspect that there's some real risk here, a potential rotation, break in leadership? A lot of this has to do with some of the fundamentals that I've outlined, but also some of the tactical material we're looking at. The recent report we published in the Signals, our monthly asset allocation report, flashed the sign that the momentum measure, the reading for crowding, has spiked to a very negative position. And the idea here is when we look at leadership in markets, it's very popular to use the term leadership and crowding. The question is, what do people mean? And in some ways, a really nice and easy way to estimate how crowded the markets are is to use, how many stocks are really driving the market gain. And a great example of 2023 is that only 7 stocks accounted for a remarkable amount of gains. In fact, this Nifty 7 per se is now almost 30% weighting in the S&P 500. That's very, very dramatic if you look across history. Importantly, though, that is not a great measure of crowding, as much as it is telling you you're in an unusual territory. What's important is that if these stocks are outperforming, the more important question is that are the earnings catching up with the share prices? And at some point when they begin to deviate, that's when you have a problem. So our CPQ polarization measure is a valuation model. It says, what are the darlings of the market? Take the basket of stocks most love, momentum basket. What's their common multiple? What's a simple PE reading on that basket? And then more importantly, what's the normal price for that basket? And if you go back a few decades, what you learn is that the basket is priced somewhere between parity and a 60% premium. In other words, it should generally trade at a premium. But what's reasonable? Once you're over a 1.7 reading, 60, 70% premium, you've got a problem. In the month of January or at the close of December, this model spiked to a 131% premium. So what we're getting at is 2 moving parts. One, the leadership basket became more extreme and the share prices ran higher. So to some degree, this is a tell sign that tells you that you've got yourself the beginnings of the break in leadership. So what does this really what's the conditional results when we're in this zone per se? So number one, you're looking at a lower returns market. Number two, certain characteristics break down harder, other characteristics offer support. And what are they? So if you look at this model, and this is going back to the white paper we wrote a bunch of years ago, when the signal goes into the red zone, the large cap expected return shifts from about 3% to about 1% if you look out 3 months. So what you're looking at here is a significantly lower expected rate of return from a normal reading to an extreme reading. Smaller stocks go from a 4% expected return on the quarter to a loss of 2% on the quarter. And so this is terribly important as a factor. It is more tactical in nature, but it's really rounding out things we're observing in the fundamentals when we look at valuations and earnings growth. So importantly, though, it's not good enough to focus on what this is telling us for the market, but as active investors, what more can we learn? And what we find out is that the beta factor is one of the most negative sensitive measures. High beta baskets break down roughly about 8.5% the subsequent window. Trending factors break down about 6% versus, and business expectations break down by 4%. So what we're saying is like the stocks that led the trending, the high octane that's there, these are the stocks at risk. So how does this play out fundamentally? This is a tactical model, it's quantitative in nature, but what's the real life experience? What this is saying is that expectations are so built up for these shares. A few things could happen here. One, you could come into the earnings season and the firm guides slightly lower. In that instance, with these specific 7 names or so, what will happen is not just that the shares will trade down marginally, but you're likely to see more sizable gaps. That's what the volatility data tells us next to these returns. And so intuitively, while this is tactical, the way it plays out fundamentally is really, is the business, if the market's pricing the business at X, is the earnings guidance at X or sub X? And that's really the divide here and what's intuitive about this model. Let's take the other side of this. When you have a crowded market and you want to offer protection, what can you do? Empirically, what we find is that valuation factors, or paying attention to valuations, are constructive. They're sort of flattish in this sell-off window. Bear in mind, if you get leadership to break, it's hard to see anybody truly winning, but are there groups and areas that can offer some protection? So the idea is that the valuation factors, becoming a little more valuation sensitive, is a good thing. Maybe taking profits is a good thing. The other factor that seems to matter is that there is a quality bias as well. So to some degree, this tactical measure is really framing our current take. The good news in all of this, though, is it's not like we're not screaming, house on fire sort of call, partly because some of the fundamentals in the market are pretty decent, as best as we're seeing in forecasting. Importantly, other tactical models haven't fired off as yet. So if you look at risk appetites across the system, it is definitely on the mend. It is definitely picking up, but it is not hitting some extremes that we're starting to see in the crowding area. In fact, when we look more broadly to the work that we publish, if you go into the asset allocation work, that model is also still pro equities. Granted, the pro equity exposure at the beginning of last year was quite higher than where it is today, but still nonetheless above it's above its sort of long-term average. The long-term indication for equity allocation is about 49%. We're currently still in the 60s. So in net, when we take this crowding measure into context, the idea is that we really do have to look out for intra-equity market rotation. We should be chasing fundamentals, not share prices. These things, they feel about right. And they're not disturbing. It's just that it's quite possible that the numbers, the gains, aren't going to be as dramatic. One of the things we'll talk a little bit about is, if you go into a more valuation sensitive market, the reality is that you're not looking at sexy returns. the value cycles tend to be lower absolute returns market. Not terrible markets, just not explosive. So yeah, we'll get into that. What I want to do now, though, is really shift gears into this idea of a potential rotation and why would leadership break. Here, all along, we've talked a little bit about some more tactical elements that are driving this. When we look at the spending patterns in the technology sector, and we've done a lot of work on industrials and technology in the last few years, one of the biggest takeaways we've got is the industrial spending cycle is on the mend. It's in fact jumped from 3.9 to 4.4% of GDP in the last 2-3 years. So what we're saying is that the fundamental spending on industrial capex is starting to reaccelerate. What's just as important, and this really creates a conundrum here for most of us, is that the technology spending component of capex is sort of flatlined, marginally slower in the last 2 years. And so what can we take from this? This is ultimately telling us fundamentally we've got ourselves a massive rotation likely, that what we've gotten is we've come to the post-pandemic experience where the pandemic sort of created a backdrop where the spending on technology goods and service had to accelerate. And in many ways, we've drawn parallels of this to the Y2K movement. Again, another window where spending for technology goods and services were pulled in several years. And as we exited the Y2K moment, the only thing that was left was really a slowdown in tech consumption because firms had really accelerated their spending, just like the sort of COVID moment. So we think fundamentally that's what's at play here. It's not that technology spending is that awful. It's just not accelerating. And I think to get the sort of multiples we're living with right now, to justify that, you really need a spending account that's likely to accelerate. So that's really what, I sort of scratched my head about 2023, which is the fundamentals aren't going quite right. And yet the share prices have just taken off. Now, the one term I haven't used here is AI, right? We do understand that the NVIDIA trade was really the market, and all investors have really flocked to this sort of area. The interesting thing, however, is the overall aggregate in spending in technology. It's really not accelerating, and if anything, it is slowing. If you look at the broader semiconductor chip data, that's also net slowing. So this is a little bit of it's tough to sort of like explain away, but it is a reality of a risk that's outstanding. The unfortunate thing with markets is that it is efficient, but we don't have to always trade on the fundamentals. In fact, let's take this a little further into one of the forecast models we have for technology consumption. That's the digital deflation reading. When we look at that reading versus valuations for the sector, we have an incredible dichotomy that's open. On the one version, when we look at the sort of like digital deflation reading, that reading is 1.8 standard deviations below normal right now. Okay, a zero reading is about flattish growth. So the elements that drive a forecast for technology consumption, they have been slowing, correctly so as well, the last couple of years. And so this is what's in this type of reading. There are fundamental measures such as chip spending, tech labor prices, stock trends, and so on. A bunch of things. There's a full white paper on this that you can look up. So at the end of the day, this gap has opened, and quite honestly, this is what capital markets are about. We do get inefficiencies that open up, and they also close. And I think this is something we've got to be thinking about as we run active money. The other thing is, I am not sure we need to get too fancy with these deflation readings to kind of cut to the chase. If you just look around, you read some of the papers you're reading, venture capitalists, they've really been shut down the last couple of years. It's not like they're raising a ton of capital and putting it to work, except for that one subcategory of AI. And so a lot of this data seems to line up fairly well. And we may have built up some excesses in the system that will probably self-correct. Let's take this a little further. When we look into the sector valuations, and you never want to rest your case on valuations, right? Because excesses can run for longer than most investors can stay liquid. But when we look at both the smaller cap arena and the larger cap arena, we see two very different things. Number one, we've got larger cap technology stocks are trading at record high levels relative to their large cap benchmark. The other growth area, and we use this to sort of like contrast growth, when we look at larger cap healthcare comps, those multiples are now at record discounts. So it's not good enough to say because healthcare is cheap, we have to own it. But the reality is that what we're looking at is a massive gap. And if we start to follow the spending data, this not only creates an opportunity, a downside risk for the technology sector, but where is that money going to go? How many other places can they go but healthcare and maybe some consumer groups? So to some degree, I think this wedge that's opened is very live, and it's definitely worth focusing on in terms of where the risk to rotations can go. In the smaller cap arena, I'm worried less because the sort of massive sell-off that occurred in the smaller tech companies in the last couple of years, they never really came back to life. They haven't gained back the space that what we witnessed in the Nifty 7. So those multiples are much more benign. Underneath this commentary that everybody seems to be discounting that small caps are cheap, part of it is for this sector. The small cap growth, the technology gap is massive compared to its large cap components. And so this opens, I think, a real opportunity and defends a case for market broadening for 2024. Drilling down a little finer into the technology large, small, this is really cutting to the chase, which is now you're looking at sort of like over 30-year highs seen from the larger cap multiples versus smaller cap multiples. Let's take this a little finer. If we were just look at larger semis versus smaller semis, we get it. NVIDIA is special, but you're now looking at 30-year peaks. The last time it was like this was 1999, 2000. They were special then too, but those multiples can reverse course. And so if we're making the case that the CapEx tech spending is slowing just for reasons as basic as gravity, the fact that the spending had occurred sharply, pulled in from years ahead, that sort of breathing period here is what will really create a rift between where valuations are versus the rest of the market. Looking across the board, what's also interesting is we noted in a recent report that it was actually quite surprising to us that the industrial sector had been outperforming until 2023. Roughly as soon as the technology sector took off, their numbers were marginal. But once you looked outside of the large mega cap comps, the industrial leadership never broke. And that's really, really interesting, constructive, and fundamentally aligned that if CapEx spending is accelerating in a segment, those stocks should also be rewarded. So we are seeing that occur more broadly, the exception being the sort of the effect of the Nifty 7 of 2023. But basically, the infrastructure series have outperformed across the board in the last couple of years. And this we expect will continue given the backdrop that we've sort of painted here. This industrial bias that we've had, the fundamental support for it is this sort of like post-pandemic spend that's necessary. The reactions to climate event, and as their frequencies go up, we're building bridges and tunnels more and more often. The fact that the Ukraine fallout, the war in Ukraine, that's forcing Europe to redesigning its energy policy for the next 20 years. Those are massive events occurring that's likely to drive an acceleration in industrial spending. We've seen this before from 2000 to 2007. We saw a reacceleration in industrial CapEx. That was back then driven by China and its global efforts. And this time it is more of the environment, it's global trade, it's nearshoring, to name a few. So Let me bring this back now to the overall portfolio. As I've said before, that we've shifted to more of a GARP-centric world, becoming more valuation sensitive in the growth area, and we're definitely more of a relative value view versus a deep value, deep cyclical chase. The other thing, though, that's changed is that we've moved from the high quality skews. So in the last couple of years, not only were we in the growth area where in terms of growth, we were more in the quality growth area, but also in the value area, we're in high quality value. The idea is that if the profit cycle were to slow down or slow down sharply, you wanted the most visible earnings at the best price, not just the cheapest companies. And so what has changed? So why would we move away from that quality sort of view? So we moving from HQ, high quality growth, to GARP. And on the value side, we went from high quality value to relative value. So what's really shifted? Well, at the heart of this is the fundamentals that we're looking at. We're no longer looking at a place where the profit cycle is going to decelerate for the next couple of years, but if anything, it's beginning to stabilize. And given what the credit markets are telling us, it may even re-accelerate. So this idea about chasing quality has worked. In fact, if you look at the gains that have really transpired in the last couple of years, you're looking at a massive gap in performance in favor of higher quality. Some of this was driven in the early period of the pandemic when we should have potentially gotten more defensive, more high quality, and instead we ended up going to Zoom and buying a lot of at home living technologies. And this is really the first leg of the pandemic, really hurt the high quality bias that should have been in place, but it didn't really matter. And part two, though, was further compounded by the fact that once you went into this belief post the vaccines that you were going into a reopening, we then went off and started to trade deep cyclicals. So you had two chapters where quality stocks got hit hard. We observed that. And by summer of 21, we began to lean into quality, reacting to what the Fed was really telegraphing in the most aggressive way. But guess what? On top of that, what we also had observed is that the higher quality baskets, as we measure these traits and factors, they were selling at historical discounts. 2 years later, that is not the case. And so what we're getting at here is a market that's likely to rotate the easy sort of higher quality bias we've had for the couple of years. We've got to back away from it. And so this is something that to some degree, some of us are going to be uncomfortable with. After all, nobody wants to say that I'm going to go after and buy terrible companies. And so, it's not a great tagline if you're in the market for capital preservation to look at low quality firms. So I'm not saying that we go after terrible companies, but what I am saying is that we are paying up plenty for earnings visibility as the earnings cycle is bottoming. And that is a reality of 24 that we're going to have to reconcile. So this is something that also marks the sort of like a real sea change in the way we're framing the portfolios. One of the recent reports in the quarter I've got to come back to sort of tie this together is that, we talk about value and we can sort of try to clarify as best as we can that we're not really looking at deep value situations, but instead we're looking at more of valuation sensitive investor. We think that fundamentals matter more. All of those things seem reasonable given the backdrop we can paint. One of the side effects, though, of a value cycle is that you're looking at a world of lower returns. So one of the clear factors here is that when you're in a growth market, stocks can be more explosive. You tend to have a much more constructive, supportive Fed. So where we're at here is not a true blue value market where you may have too much cyclicality, an aggressive Fed. Clearly, we're not there. So we're not in that low return phase. But the fact that the growth multiples have expanded so much questions how much you're going to gain given a Fed move. And so this brings together really our change of the guard posture, that we are making a case for equities. It's quite favorable, but the rotational risks are significant. I've outlined them at the sector level, from tech to industrials. We talked more broadly about growth versus value. Clearly, we're moving more towards a valuation sensitive world. And if the market continues to broaden, you do migrate away from a large mega bias into a mid and smaller cap bias. So what we've gone through today, to summarize briefly, is really tactical fissures have opened. We're keeping watch of that. We're also looking at the other tactical models to see if they're going to flash red. The background, though, is constructive. Earning cycles are generally favorable. Credit markets are fairly favorable. These things, to oversimplify how stock prices trade, they trade on earnings. So if you're past the 2-3 year window of a slowdown, it's quite possible that equity prices should be consistent. That's what the work is saying. We talked a lot about a leadership handoff. The industrial spending is going to continue to accelerate. It's not accelerating in technology. We think there's good reason to see it continue to accelerate in industrials, full stop. So that sector exposure is showing up more and more prominently in small and mid-cap portfolios. There have not been there in the large cap portfolio. We think that's the big change for 24. And then finally, this idea on quality. We always want high quality portfolios. It's just that investors are really paying up for the factor quality. We need to look more carefully at that as we shape the portfolio. And that pretty much concludes my remarks here. As always, we welcome your feedback, your comments. Take a look at the full report and some of the supporting papers as well. And all the best to you in 2024. Thank you.